All right, we are live again. We had some technical difficulties here, but we were able to get back in the show. All right, so thanks, Aaron, again. Really appreciate you being here with me and your patience through these technical difficulties. But hey, uh, what's important right now is just to be able to pass a lot of good information to our viewers, right, and make sure that they understand a little bit about the market and what's going on. Is this a good time to buy a house? That's basically going to be today's subject. Is this a good time to buy a house? And what are some of the creative ways that lenders are now, some of the incentives that they're providing to buyers and even for sellers are, in this market, there are some things that sellers can do to make to incentivize the buyers to really submit an offer, and we can talk about those things as well. It's just a lot of topics, a lot of good information. So thank you for those viewing right now. Thank you so much. All right, Aaron, without further let's dive in. Okay, Aaron,
Thank
thanks
you.
again for being here. Let's kind of start talking about the market. What are you seeing right now with the market,
Yeah, no,
with
thank
the
you so
real
much,
estate market?
Carlos. Yeah, no, for sure, for sure. There's a difference. First of all, thank you for having me. It's an honor to be here. I'm watching you on social media. You're doing a lot of great things, and any of the clients that you get the opportunity to work with are just going to be in great hands because the value that you bring, the education, the experience, they are certainly making a great decision to work with you, Carlos. And what you're doing here is just this educational platform is just really huge right now because, as you mentioned earlier, Carlos, the media is driving so much fear right now. It's when you listen to the media about the housing industry, it's gloom and doom. It's the market, is falling. And listen, the market is certainly shifted, but here's the thing: the media is wrong so many times and so much of the time. And so when you talk about, hey, is this a good time to buy real estate? Well, obviously, it always depends on what is in our client's best interest. But the media would tell you it's a horrible time to buy real estate. And you know what? They've been wrong before. And I don't know if you can, I don't know if you want to share this slide that I sent over. But the thing about it is, if you look at that slide, this is a snip of the media and how nothing is new in regards to the media and the gloom and doom. If you look at what the media was telling us back in 2015, they said that there's a housing bubble that's larger than 2006 and the market's going to crash. Well, what happened that year? And these are national rates. This isn't even local to Austin, Texas, which we know we've seen much greater appreciation. But in 2015, the market in general nationwide grew 5%. In 2016, we're in a new housing bubble, the media tells us, and the market appreciated over 5%. In November, homeownership doesn't build wealth, a study finds. I don't know what study that was from, but the market grew 6% that year. In 2018, it's better to rent than to buy in today's housing market. Well, they were wrong again. The market grew 4%. In 2019, in July, the media says that the housing market is about to shift in a bad way for buyers. Well, the market grew 4%. And as you all know, if you bought a house in 15, 16, 17, 18, 19, even 20, like you're in really, really good shape right now. In December 2019, they say the next year will be hard on housing, especially in big cities. And the market grew 16% nationwide. Of course, in Austin, it was more like, 25, I think. And then in 2021, the housing boom is over. New home sales fall to pandemic lows. Obviously, we've seen a shift. But here's the thing. If you listen to the media, that would have cost the average homeowner nationwide over $250,000 in equity. Okay, we know in Austin,
Wow.
Texas, in this area, it's probably almost double that in some cases. But don't listen to the media. Is my recommendation. If Dave Ramsey even says right now is the best time to buy real estate. If you're buying it as a primary residence, you're holding it for 2, 3 to 5 years minimum, this is a great time. So there's a lot
Aaron,
more thoughts I have on that, but anyway, I thought that was pretty interesting.
it's super interesting, and you're 100% right on this. Okay, I actually earlier this year, I'm on a networking group called. I had to do a presentation, and one of the slides actually, it was just very similar to yours. I went back 7 years, 8 years actually. I think I went back, and I found news about the market. The market crashing, and the market, all these bad news about the market, and the foreclosures, and this and that. And I put everything, compile everything together with links to the news articles, and that was my presentation. Well, that was part of the presentation. It's just basically, guys, if you listen to the media and the news, I mean, they're selling you news. They're selling you, that big old flashy thing. Oh, the market is doing this, but in reality, I mean, we have all these micro markets as well, and Austin doesn't really compare with the rest of the market. With the national, there's, last statistics I heard is 180 people move to Austin on average every day. On average, 184 people, actually, I think it's 184 people every day move to Austin. That's a lot of people, right? That's a lot of people every day.
Yeah,
so
the demand certainly is here.
Yeah. So it's definitely, what happens in Ohio, what happens in Seattle, what's happening in Washington is completely different to what's happening in Austin. So thanks for bringing that up. It's you're 100% right on that. So yes, then and then you even locally here, okay, every neighborhood is different as well. A seller wanting to sell a house, in Round Rock, they have to consider, different market to a seller wanting to sell in Austin, downtown Austin, or something like that. It's just, it's all based on the neighborhood. It's all based on the local market in your neighborhood. So thanks for bringing that up. We got some comments here from Pam. So correct. Ixlay 2019 in Austin, better jump now. Right. So just imagine, last news I hear was the foreclosures went up by, I mean, the way the news make it sound is like foreclosures went up by like 300% or something like that, he said. But see, what's interesting is that foreclosures were, we had that forbearance, right? For a couple of years. We had the forbearance. So technically there was like no foreclosures happening because there was a forbearance. so there was like zero foreclosures. And then all of a sudden they say, oh, foreclosures jumped up by, 200% or something crazy like that. It was like, yeah, because there was nothing the previous year. I mean, even if it goes up by 2, that's already 200%. It's just the way that the news make it sound. Anyways, anything else, Aaron, you want to add?
No, I was just looking for a slide that I had on foreclosures. I'm not sure if I can find it, but your point is exact, right? The media is going to say foreclosures have skyrocketed, right? But when there's zero foreclosures there's a moratorium on that, right? Banks could not foreclose. They rolled out the forbearance plans, over the last couple of years. Still have clients that have taken advantage of those up until recently. And so, yeah, I mean, again, it's the media, it's their spin.
All right, so let's talk about this.
I will say this, Carlos. Will say this to that point. The one thing to keep in mind, with foreclosures and why we saw more of those after 2008, is that the equity that the average homeowner has in their homes right now is so much greater than they had in 2008 when we were doing loans at zero down. People were, way over. Under the water, right, on their mortgage loans compared to the value. And so there was a lot of foreclosures then, but there's just not going to be very many foreclosures this time around because there's so much equity that people have in their homes, and they have these super low interest rates as well on their mortgages, and so their payments are lower. You're just not going to see very many foreclosures compared this time around compared to 2008.
That's exactly right. It's nothing. I'm not even gonna get into it. We had many discussions about this. we're not, this is not 2008, and buyers are financially more strong, right now. They have to go through, higher credit scores or higher down payments, or I don't know. It's just the lending, the
Good
banks, the
loans. Yeah.
lenders have the loans, they're stronger than what they were back in 2008. I remember like people without a social security number, they were able to buy homes very easily,
Yes.
with like very little down. Nowadays, for my I-teen friends, at least you have to have an I-teen, which is, pay taxes in the US.
Yes.
And then even then, most of the lenders are doing like 15 to 20% down payments, for those type of loans, or the bank statement
Correct.
loans. You have to do bigger down
Correct.
payments than before. Anyway, so all right. I wanted to share some slides, but let's just kind of talk about this. You know, I get a call. When I talk to my clients, my prospect, people thinking about buying a home, but they're kind of
Mm-hmm.
on pause. They don't know what's going on. They think, well, they're waiting for the market to crash, which, in my opinion, that's not going to happen. But yeah, we're in a recession. Whether the government accepts it or not, or
I
recognizes
agree.
that we're in a
I
recession, we
agree.
are in a recession. But it's just we have to be able to pass the correct information to our clients, and
Correct.
there's so many opportunities right now, and home prices are high. Yes, they're high, and interest rates are high. Correct. But my question to them is, where do you think we're going to be in 5 years from now? That's a simple question. Do you think home prices are going to be lower, 3 years from now, or 5 years from now? I mean, buying a home, most people, the average, I think, is like around 7 years. They stay in their homes for about 7 years. So, I mean, are you thinking, look, like you were saying, Aaron, at the beginning, whenever is their best time, whenever they're qualified, whenever it's good for them, that's when it's the best time to buy a house. Don't wait for the news
100%.
to tell you when to buy the house. We're not trying to time the market. Timing the market, if everybody will be able to time the market, everybody will be rich right now, right? You'll time the market on the stocks. You'll know when to buy, sell the stocks. I mean, real estate is something similar, in my opinion. Timing real
I agree.
estate, timing the market. By the time you want to jump in, it's going to be a little bit too late, because now you might have multiple offers, and we're going to be back again to the same situation, right? Multiple offers. Now you have to maybe go over asking, and
100.
it's just, don't try to time the market. My advice, buy the house when it's a good time for you, when you can financially afford the house, right? When you have the good credit scores, when you're financially
Yes.
stable, you have a good job, you're going up in the ladder, right? Like, things are going well for you. Your wife is working, you're working, there's enough income coming in, low
Yeah.
expenses. That's my opinion. That's when it's a good time to buy the house. If you're thinking about buying
100%
a house
agree.
now, yeah, and selling the house, 2-3 years from now, well, maybe you want to wait, right? If you're going to sell the house in 2 years or less, might not be the best. I don't know. Nobody really knows what's going to happen in the future, but in the long term, 5, 7, 10 years from now, more than likely home prices are going to be higher, right? So
Yeah.
don't wait for
It's
that to happen. I talked to many
right.
buyers, and they've been leasing for many years, and because they're always afraid to make that move. I mean, they're always thinking, oh, there's always going to be better next day, but then next day it's higher prices, or something else.
100%. My financial advisor says it's not about timing the market; it's about time in the market. And I think we would be wise to apply that to real estate as well. Like you said, if
Mhm.
we're, you have to look at it as if you're a prospective home buyer right now, and you're on the fence, and you're considering, is this the time to buy, or should I wait? I think you have to look at a couple things. Is this an investment for you? Is this an investment property, or is this your home, right? And like you said, Carlos, I agree 100%. If you're going to be there for 2 to 5 years plus, I personally believe this is a great time to enter the market. Like Pam said earlier, it's getting close to like 2019, as the prices have started to come down. And think about it. Like, if you're a first time home buyer, like, this is your time to shine. Like, the last 2 years, you couldn't get an offer accepted on a home for the most part, right? You would have had to make, 50 to 100,000 over asking. You would have had to bring a lot more money to closing. You would have had to sign an appraisal waiver. You would have had to, put a lot more money in earnest and option. The risk was higher. You had zero time to think. And so right now, it's totally your time to shine, because you can go in and more than likely, in a lot of cases, you can get under contract on a home for even possibly under the list price, getting closing costs paid for possibly by the seller, buy down options to get your rate down permanently or temporarily. And so if you have a VA, loan, FHA loan, if you're a first-time home buyer, like, this is your time to shine. I never force, of course, or pressure anyone into, making quick decisions, but what the word that I like to use right now is explore. Like, if nothing else, like, get with a trusted realtor and lender and get pre-approved. Explore the market, because listen, and I don't want to be a hypocrite here, Carlos, but like, because I think we have to ask ourselves, like, if we were buying right now, like, what would we do? And I think if this is probably not like, I don't think we're at the bottom yet. Who knows? But we got to be really close. Okay. And so we're not going to time the market, but if I'm going to stay in my house for the next 3 to 5 years, anytime between, last couple months and the next 6 months, I personally believe there's going to be some great buying opportunities. As a real estate investor myself, like, listen, I'm keeping my eyes open, because I feel like there's going to be a lot of great buying opportunities.
Right. And you know what? This is honestly, like, this is the way I feel about the timing. I'm actually, Aaron, I talked to you about this last time I met you, about the investment property I was thinking about buying, the fourplex. I'm closing tomorrow. All right.
Dude,
So I'm
that's
closing.
awesome.
I'm
Bam.
closing on I'm closing on an investment
Good
home
for you.
tomorrow. So me personally, I'm buying real estate right now. Like,
Yeah.
yes, I'm not super happy with the rate that I'm getting, but again, it's an investment property. Eventually, I'll refinance. If the interest rates go down, hey, if the interest rates go down, great, I'll refinance. If they
There you
don't go
go.
down, ever go down, if they don't ever go down, I bought at the perfect time, because they're not coming down, right?
Right.
So
Right.
it's either I'm buying low right now because they're never gonna go down. They're always gonna be going higher, which I don't think is gonna happen. But eventually, when they do come down, then I can just refinance. To me, it's an investment, long term, something I want to leave behind for my kids. So I'm not thinking about selling this thing in 1, 2, 3 years. So I'm actually buying right now. So
100%.
yeah.
No, see, you're living by example, right? For sure. And I applaud you for that. Certainly, we are in the same boat. And I think that, if you're a potential home buyer, you can't be frozen by fear. You have to explore it. It's still better to own than to rent in most cases. We can, show you rent versus own analysis. The other thing, homeowners' net worth, 40 times higher net worth versus a renter's average net worth. And so certainly over the long haul, everyone would agree that owning a home makes more sense. But I think the thing to think about too is that with the home values as they've come down, right now over the next 6 to 9 months, you're going to be able to get a great deal on a home and buy a home closer to what they were in the 2019, to early 2020 range. Yes, with a higher interest rate, possibly, if you don't take advantage of buy down opportunities. But then, like you said, Carlos, you can acquire the home at today's lower prices and then refinance in a year or two when the rates come down to a much much lower payment. So it's like it's like the best of both worlds, right?
It is. All right, so let's talk about some of the buy down opportunities, like you just mentioned. Okay, I know a lot of builders right now. Okay, they do have a lot of incentives right now, builders, and there's basically negotiations. If you're buying a resale home, a used house, a resale house, negotiations are back. Okay, on average, my all my offers have been below asking, when I'm representing the buyers. Okay, below asking, all the offers, anywhere between 10 to 25,000 below asking, depending on the house,
Yeah, I believe
and
it.
and how long it's been on the market, if the house is vacant or not. I mean, all these are factors about where should we go when we submit an offer. We're gonna be at list price. We're gonna be higher than list price if multiple offers. Right now, all my offers have been below asking. All the ones that I submitted since May have been at or below asking. So negotiations are
Wow.
back. We're doing longer inspection periods. We're not waiving the appraisal. Like you know we're I'm protecting my job is to protect my clients, right? There's like 40
That's right.
ways to terminate the contract on for a buyer. There's like 40 different ways to terminate the contract. And um and i'm i'm utilizing all these opportunities, right, to always protect my client. When during COVID, there was like everything was out the window. Is like no contingencies, nothing. Like, this is the offer.
Yeah.
And
Totally different
20%
world.
over asking. Yeah, my clients were submitting 20% over asking just to be able to get the house. 20% over asking. I mean, you're talking is a
It
big
was a
chunk. Right
thing.
now, i'm
It was
doing
a thing.
i'm doing way below asking. All right,
Yeah.
so what are some of the like I mentioned, the builders are now offering incentives. Now the catch is that all right, so if you use the in-house lender with the builder, they'll give you some benefits. They'll give you a lower interest rate, but you don't have to do that. Like, Aaron, you guys provide some similar incentives, right? Different options to the buyers for them to get into a house with a lower interest payment. Let me share your screen here. Do you wanna go over
Absolutely.
some of these numbers?
Absolutely, for sure. You mentioned the builders, and I'm seeing, a ton of incentives right now that the builders are throwing out. And Carlos, I mean, I'm the preferred lender on a builder account as well, and there's just so many opportunities for buyers at this level. And whether we are the preferred lender or not, we still have a lot of great opportunities for home buyers to take advantage of in this market. One that I would like to highlight here, and you have it up on the screen, it's a 3-2-1 buy down. And so basically, it helps solves the affordability problem in the short term. And so the one thing I love about the 3-2-1 buy down, and you could do a 2-1 buy down or a 1-0 buy down, and these are temporary buy downs. And so to put it into context, you have two types of buy downs. You have a temporary and a permanent buy down. And basically what it is the seller or the builder is going to contribute a certain amount of money to give to you as a credit so that you can buy your interest rate lower, or you can use that as well to cover all of your out-of-pocket closing cost expenses. And so one of the ways to get an interest rate right now 2 or even 3 percentage points lower than market is to take advantage of the temporary buy down. That's what you're looking at right now on your screen. And so the highlights of this program, guys, is, for example, let's say the far right column, let's say the market rate today is 6.5%. Let's take a $600,000 home value, 20% down. Let's say your payment all in, taxes, insurance, everything is $41.83. Well, if you take advantage of the 2-1 buy down, 3-1 buy down program, the first year, your monthly payment is going to be based on an interest rate of 3.5%. And so your monthly payment is going to be $878 in this example, lower than the market rate, which is huge, a huge savings, right? There's a lot you could do with that, right? You could prepay your mortgage, you could save, pay off debt, a lot, invest. And then in year 2, that temporary buy down moves to where your monthly payment is based on an interest rate of 4.5%. So year 2 is 2 percentage points lower than market. And then your monthly payment is $600 lower than market. And then in the third year, if you haven't refinanced by then, that moves to 5.5%, still a percentage point lower than market, with a $308 savings per month. And then, of course, in year 4, that temporary buy down moves to a permanent at whatever the market rate is, in this case, an example, 6.5%. and that's for it's a fixed rate, so it's that way forever until you sell or refinance. Obviously, the goal and objective is to take advantage of the super low payment for a year or two, and then refinance into a permanent fixed rate whenever they get down to hopefully in the fours again or low fives. So this is just an example of a 3-2-1 buy down that's out there right now that buyers certainly can take advantage of to solve that affordability. Basically, you're getting a monthly payment that you're super comfortable with for a couple of years, and then you refinance to a payment that you can certainly maintain for the entire time that you have a loan.
That is awesome. That is an awesome program. It makes home buying a lot more affordable. $878 less on your monthly payment. That's a big chunk. Okay, so basically, I mean, just in simpler words, if the interest rate is 6.5, you're basically reducing it by three points, right, down to 3.5 for the first year.
Correct.
Then you reduce it only by 2, so that will go up by 1 point, so 4.5, and then 5.5, and then you'll go to the 6.5. Now the idea here is that to take advantage of this for a couple of years, and then as soon as you see that opportunity, the interest rates are like you said below 5, then go ahead and just refinance into a 30-year mortgage, and then you have fixed payments, and then no matter what happens with the economy, you already here is like also, I mean, you get 3.5 the first year. No matter what happens with the economy, you're fixed for the full year.
Right.
And the interesting thing is that one thing that you didn't mention, Aaron, is that this cost. Let's talk about the cost to actually do this,
yes,
right?
Thank you.
And then if you want to mention that this is actually something that the seller has to pay. Okay, so you as a buyer, you're taking advantage of this. They will have to talk to a lender, and that's why it's very important to be like, this is a teamwork. Okay, we all have to be, the buyer has to consult with the realtor, they have to consult with the lender, we all have to work together and know what's the plan, like what's the plan of action. In this case,
100%.
Somebody will approach you, or I will ask you, hey Aaron, I got this client, he's interested in doing the 3-2-1 buy down. How much money do we need to ask from the seller? Right? Because this has to, I think one of the rules is that this has to come from the seller, correct?
It absolutely does. And I appreciate you mentioning that, Carlos. The great thing for buyers about this program is that they can't pay for it. The seller or the builder has to pay for the 3-2-1 buy down, any temporary buy down program. And so that's a great thing about it. And I added this to the screen here, and this is a calculator that I know you have access to. It shows you what the cost is, and it calculates the cost of the temporary buy down program. So for example, the 3-2-1 buy down, in this scenario that we were just looking at, you can see here that the cost is a little over $21,000. And so you would just go in and structure and ask the sellers for a little over $21,000, and boom, the buyers could take advantage of this program. Now, certainly, you may be in a situation where you can get more than 20. Maybe you're getting 30 or 40, from the seller, and you could do a combination, split it up. And there's another slide I have about that highlights that. Is maybe you take half of it and you reduce the sales price, and the other half you take advantage of this buy down. But here is something that's really gold that nobody's talking about this, Carlos. And here's the thing. Again, the $21,000 cost for that, it prepays, the difference in the interest, right, of those payments for each of those years. You can see the first year it's costing a little over $10,500. The second year, $7,200. Now, what happens though if you refinance after year one? What happens to the leftover credit, that extra, $11,000 that's left over? The great thing is, whatever's left over when you refinance, you get to keep. The buyers get to keep it in the form of a principal reduction. And so when they go to refinance, they don't get it in cash. But when they go to refinance, they pay off their loan of $480, for example, and let's say there's $11,000 left. Instead of refinancing the $480, their loan balance would be $469. So they use that, right, as equity. And so it's a phenomenal part or feature of this program that not a lot of people are talking about. It's a huge benefit to the buyers.
Yeah, I mean, and these are things that that have always existed. They're always been there. I
Right.
always heard about buying down points, but the options that I heard more were like, okay, you buy down the point, you buy down the rate 1 point, but then for the 30 years, basically, right? So it's
Yeah, permanent
then,
buy
but
down.
then the
Yeah.
permanent buy down. But the thing with that is that the permanent buy down, let's say you do buy the rate by 1 point, but then the interest rates come down again, and then you see, oh, maybe I should refinance again. Well, you do refinance again, and guess what? You lost, because
You
every
lost
time
it.
you do, you lost the money. So when I talk to buyers, I have to we always kind of have to run the math really quickly. Okay, you want to do the points buy down, okay, the rate buy down. Okay, let's see, what's your mortgage payment normal at the market rate? Okay, what's your mortgage payment? What is your mortgage payment, your monthly payment, principal and interest, if you buy down the rate by, let's say, 1 point? Okay,
Mm-hmm.
well, that difference, let's say $70. Okay, I'm just saying $70. Okay, well, how long is it going to take you, $70 every month, to pay off that initial investment that you're making? Right, you're making that initial investment
Yes.
of, let's say, $4,000. Okay, well, how much time, how many months is it going to take you to really, to recover that $4,000 investment that you're making up front? Well, is it
Yes.
going to take you 5 years to do that? Then, in my opinion, it's probably not the best option to really buy down the rate. Or maybe you don't want to
Right.
buy down that much of a rate. Maybe you just want to buy down, a little bit. But
Good
yeah,
advice.
so basically, you have to do the math. You have to do the
You
math
do.
and see how many years it's going to take you to recover that amount. In this
We
case, why do we have to do that? Because if you refinance again and you didn't wait, the 4 years that it was going to take you, or 3 years that it was going to take you, then that's
right.
money lost, right? In this case, you're not losing any money, right? It's credit to you again,
Yes.
towards the balance, towards the principal, you said, right?
Yes, that's right. Yep, towards the principal balance. So if you're refinancing 480, then there's 10,000 left over, then you're only refinancing 470. You're getting that in equity, which is huge. You were talking about something that's really good, Carlos. It's just a smart way to think about it. And it's called the break-even point, right? And I was a financial advisor before I started my mortgage planning practice, and we would do that on investments all the time. And so you do have to look at that, and it's not, buy downs are not for everybody. If the cost of the refi is just say $5,000 and you're saving $200 a month, well, you got to do the math there. It's about a 25 a month break even, just a touch over 2 years. That may or may not be. That's usually a really good break even. But right now in the market, I'll be honest with you, 99% of the time, I am recommending that my clients do not pay money out of their pockets to get a lower rate. I don't believe in the buy downs right now, the permanent buy downs for the clients. But the seller, the builder, they're going to contribute towards it. Yes, let's look at that closely for sure. But most people, not everyone, but most people will be in a refinance opportunity in the next 12 to 24 months. And so we have to look at everything through that lens, when we're making recommendations. And one cool thing that we're doing for all of our clients, Carlos, any one of our clients, we're offering free refinances, over the next 3 years for any of our clients, because we know there's going to be a refinance market, and we want to make sure they're getting the best advice possible now and when it comes to that point. And so we want to guide them each step of the way with really good advice.
That's great, Aaron. And you know what? I went live last week on a Spanish radio station, and I was just mentioning that buyers nowadays, they have that option to, refinance for free. All that, I'm thinking that loan origination cost is gone, is down to zero. So basically, they will just have to pay the title policy, the title paperwork, and maybe the appraisal or a few things. But the biggest of the chunk, which is the lending fees, those are waived, I'm thinking, because
Correct.
of the free
Yeah,
refinance. So
we're going to waive
so
those. Yeah, that's right.
Yeah, and I talked to a few other lenders, and they're not really doing that. So you guys have a really good options there for the buyers. And again, negotiations are back. You're doing, if I approach a seller, I approach the listing agent, the other party, and say, hey, my client wants to submit an offer on your house, but the only way we can make it work is by doing the 3-2-1 buy down, rate buy down. Okay, that's the only way we can make it work. Are you guys willing to work with us? Okay, yes. What will it take? Okay, well, I talked to Aaron Page, and he said that we need 21,000 to make this work. Are your clients willing to give us a credit of $21,000 to be able to use that towards closing and buy down the 3-2-1 buy down rate? There's a higher chance for us to do that in this market. We're in December, we're in the holidays. Most of the people, they're kind of on pause. They're celebrating, they're getting ready for the holidays. And we're typically, historically, real estate goes up and down, but so right now we're kind of in the slowest season. These months are the slower months of the whole year. So I think it's a good opportunity. Inventory, I'm not going to get to show some of the graphs that I had planned, but inventory, earlier this year, we were a 0.3 months of inventory in Austin, in Williamson County and Travis County, which is the all MLS areas here. 0.3 months, which means less than 2 weeks of inventory. What that means is that if we don't get any new homes for sale, that current inventory, that 0.3 months of inventory was only going to be good for less than 2 weeks. And then all of those homes will be gone. That's where we were at the beginning of this year. My clients were still submitting 10% over asking. It wasn't as crazy as 20% like last year, but it was easy, 10% over asking to be able to compete in this market. Now we're at 3.2, past 3.2 months of inventory. So for a buyer,
big difference.
We're in this big difference. We're at the slower season of real estate. Okay, everybody's focused on the holidays. Right now, we have so much inventory. So many homes are sitting there without showings, without offers, and they're just waiting for you to make an offer, right? For sure, they'll be willing to negotiate. For sure, they'll be willing. More than likely, they'll be more open to those negotiations. So inspections are back. I remember calling my inspector saying, "Hey, can you be there tomorrow? Like we need you to be there tomorrow because the option period ends tomorrow at 5. Can you be there tomorrow in the morning? Tomorrow at 9 a.m., 8 a.m., something like that? Because we need to know,
options.
2-day option periods, right? So that's gone, in this market.
And no more appraisal waivers, right? Have you even heard the word appraisal waiver lately?
Yeah. Can you go over a little bit about an appraisal waiver for those that are not familiar with that?
Well, yeah, I was asking, the appraisal waiver. And so, 8 months ago, all of 2021, probably at least half of 2020, when you go to make an offer on a house as a buyer, it was so competitive. You were lucky if your offer was chosen. If your offer was chosen, the seller was going to demand in most cases that you sign an appraisal waiver, which basically means if the house that you bought was contracted at $600,000, for example, right? If the appraiser went out and he valued your house based on the comparable solds at, let's say, $550, then there's a gap, right, between the sales price of $600 and the appraisal value at $550. And so from a lending standpoint, we're going to lend based on $550 and not $600. So there's going to be a $50,000 gap. And so there's some ways to mitigate that depending on how much money you're putting down. But in a lot of cases, buyers were going to have to make up the difference and bring an extra $50,000 potentially to closing. And so you were signing a piece of paper, an appraisal waiver saying, if the appraisal value comes in lower, I'm going to take that risk and I'll pay the difference.
Yeah. So basically they're saying, I'll pay whatever the offer price was. So we're offering 500,000. That's what I'm paying, no matter what the appraisal comes back at. And it was really challenging for my clients, for buyers to even submit an offer because we knew we had to go over asking. They were qualified to go over asking. Okay, they were qualified to go over asking. So that was a good thing. But that's not everything. I said, yeah, we have to go over asking, but now we have to do the appraisal waiver. Do you have any money on the bank in case it doesn't appraise? And that's
Exactly.
where most of my clients were like, wait, what do you mean? Like, yes, and I had to go into details, and they say, you know what, we want to go over asking, but we don't have the funds, because you need the
Yes.
down payment, you need the closing cost, and then forget about asking the seller for any kind of credit, during
Oh,
COVID,
yeah.
right?
No, no,
Like,
absolutely not.
forget about asking that. So, the type of loan, the type of financing that you're getting is already, it was already looked at. They were choosing those with the bigger down payments, right? But then, even if you're qualified and fully pre-approved, and you have the money for the down payment, and you have the money for the closing costs, now do you have the money extra just in case it doesn't appraise? And a lot of the
Yeah.
transactions did not, a lot of them, appraisers were not keeping up with
No,
the
there's no way they
offers,
could.
that people were submitting. So a lot of people had to put a lot of money, to make up for that appraisal. So, guys, we're not in that same market. We're not in that, we're not doing those appraisal waivers anymore. Inspections are back, negotiations are back, and now we can ask the seller. We'll analyze every house. We'll see how long it's been on the market. Is it vacant? If the house is vacant, the seller's already moved out. It's costing them electricity. It's costing them taxes. It's costing them money just sitting there. They're still making that mortgage payment, more than likely. So, I mean, it's a good chance for a buyer right now to submit a house on an offer on one of those
It,
vacant homes.
it really is, Carlos. And basically, what I'm seeing across the screen here is, do you think it's a good time to buy a home now? And what you're saying is so true, Carlos. And here's the thing, it just keeps reminding me, like, the answer to that question, because my clients think I'm crazy when I say right now, it in a lot of cases, it's cheaper to acquire a home than it was 2 years ago, and even 1 year ago. And they're like, what are you talking about? The interest rates are like more than double. It's way more expensive. And when I show them the real comparison, the numbers, it's not that far off. I don't know if you're able to show that screen again, Carlos, but it might be a good one to really just kind of hit home again on the comparison of what it would look like to buy a home back in February, even of this year, compared to this month. And so, as you can see, in February last year, the year before, on a $600,000 list price, you were more than likely going to have to pay close to $100,000 over asking. And so that purchase price was going to result in an appraisal gap. You're going to have to bring more money to closing, even in a best case scenario. Let's say you only had to bring an extra 20K, just to be very conservative here. Yeah, your rate was going to be 3.75, which is like really low and just is awesome. Okay, for sure, no doubt. But you got to look at the payment, right? The payment was going to be $3,450, right? But here's what people are missing. Okay, look at that cash to close. It was going to cost you $169,000 to acquire that property, 20% down plus the appraisal difference. Now compare that to right now. On a $600,000 list price, more than likely, good chance you can get it
20
for
below.
20,000
Right.
under, right? Yeah.
Right.
Is that? I mean, that's realistic, right?
Very realistic.
So,
Yeah, 25,000 below asking right now. Easy.
yeah. So let's say you get that for 580. Yeah, the interest rate's 6.5%. They have gone down. We were at 7.5 for a while, and now we're back lower. And these are averages, right? But look at your payment, $3,882. That's less than $400. Like, less than $400 a month difference. A lot of people are thinking, the media is like, oh my gosh, like your payments are going to be thousands of dollars more per month. Well, comparing apples to apples, that's just not the case. But here's the kicker, right? Look at that, the cash to close, only $125,000 difference, right? So, 169 minus 125, that's about a $45,000 difference in cash to close in your pocket, right? And so, but here's the cool thing, right? Let's say you take advantage. Let's say you acquire the property for 600 and you do a permanent buy down, which I would not recommend in this market right now. But let's just say you did. You could get your rate down to 5.5% by taking $20,000 and using that to buy the rate down. Your payment goes down to $36.75, which is of course still about $225 more per month compared to if you bought it in February. But look at this. What if you take that 20,000 and you apply it towards just a 2-1 buy down program? In that first year, right, your rate's 4.5%. So the first year, your payment is $33.82, which is less than, right, your payment if you purchase the house in February with that super low rate of 3.75. And so then you refinance. You know, if you can refinance after a year or two, and then you're basically at the same payment or lower than if you bought the house in February, and you have more equity because that value of that home, you bought it at a lower clip. So when I walk my clients and prospective home buyers through this, they get it and they're not as scared, and they're like, okay, yeah, the media has been lying to me. This is the truth of the market that we're in.
It's exactly correct, and that's my job as a realtor, just trying to pass that knowledge to my clients. I mean, I try to do my best, but it's not always, it's not always the easiest when you're on the phone call, when you're really, you need a professional like Aaron Page, here to really analyze every situation. Every buyer is different, all right, and every house is different, so we have to look at real numbers and just show you, like, this is numbers don't lie, right? Like, these are all the different programs available, and we can do these things for you and make it, it's more affordable, definitely more affordable. And I have some message here, the 30-year fixed rate mortgage. I think I saw this news 2 days ago or so, a few days ago, as of December of this year. It was around 6.5, and then for the 15 rate around 5.7, 5.76. Do you think that's pretty accurate?
Yeah, okay. I think it's very accurate. Yep, it's obviously there's like 26 different criteria that go into an interest rate. A lot of times people are like, hey, my buddy down the street, he got 5.5, and buddy got 6, and so obviously there's a lot of criteria: credit scores, loan programs, purchase price, loan to value, how much put down, a lot of factors. But yes, that's what I'm seeing as well. And so, which is huge because, again, rates tipped around 7.5% range, for a while there. And so, as you can see, rates have moved down. What everybody's asking us, like, what do you think is going to happen, with interest rates? And, Barry Habib is like one of the experts in terms of mortgage rates and the bond market, and his prediction is that every time the Fed meets, and they're going to meet again, I think on the 14th of this month, when the CPI numbers comes out, if the CPI numbers continue to show that inflation is cooling, mortgage rates should continue to move down after those meetings. And then in February, March, when those numbers come out, if it continues that trend, then we should start to see rates move down at an even faster clip. So who knows what's really going to happen, right? But that's what the experts are saying. We could possibly even see rates, in the mid 4s by the end of next year. I think there's a really good chance we'll see them in the 5s, worst case.
Yeah, I totally agree. That's kind of my prediction as well. I think rates are gonna come down below 5 probably within the next 12 to 24 months. So taking advantage of a 2-1 rate buy down or 3-2-1 rate buy down, I think they're great options right now. And again, that cost has to be paid by the seller. So the seller has to cooperate with us, has to, they're like, hey, I want to buy this house. I need the 3-2-1 buy down to be able to buy it. I need $21,000. Help me out, right? And they'll be more open to do that. But anyways, Aaron, well, we've been live for almost 50 minutes. Thank you so much, Aaron. Yeah. I mean, honestly, we could be here for hours, and there's a whole bunch of slides that I didn't really get to show, but I just wanted to hear it from you. And I really appreciate all the insights, all these knowledge nuggets that you're giving us. And just to remind the buyers, I mean, again, don't focus on the media. Every market is different. I mean, you're listening to news happening in other states of the US, right? Listen to the local news, and even then, just think about this. Think about all the companies moving to Austin, right? We got all these companies moving from California. We got Tesla, Oracle, all these, Samsung opening up soon here in Taylor, Texas. And we get all these companies here investing in Texas. 184 people move to Austin on average every single day. They need a place to live. So Austin is very unique. It attracts a lot of people. And so I think we're going to be okay. I think we're going to be okay. I'm not afraid. I mean, hey, I bought a house. My first house I purchased in 2004. What happened in 2008? What happened in 2008? I mean, my house was underwater. Like, I'm sure, I don't even know how low it went, right? But you know what? I still had a job. I was still making the payments. Now I still have that same house. It's an investment home now, right? I'm getting cash flow every month from it. It's producing money. It's paying off by itself, right? By my tenant. And then now it's appreciated. It's more than double than what I bought it for, right? So
for sure,
it's just like I'm here for the long term. If I love Austin and I'm planning to stay here, so why not start investing now? Now if you do have to sell it in 5 years, more than likely you're gonna be ahead. That's kind
of for sure. I mean, we bought our first house in 2004 as well, and we had it for 7 years. We sold it in 2011, which still burns me today that we did that. But we still made like a $40,000 net profit off it, and that was with the decline in 2008. And that did a lot for us. It allowed us to do some things to get started in this industry, in this business. But Carlos, I mean, I think Austin is such a destination place, right? You talk about all the businesses moving here. It's so true. People want to be here in Austin. The downtown skyline is just unrecognizable compared to where it was 15, 20 years ago. How many of us would buy stock if Austin was a publicly traded company? Like everybody, right? Yeah. I mean, but think about it. Like owning real estate, like it's probably the closest thing we're going to get to owning a stock in Austin, Texas. And so I think it's still a phenomenal opportunity to do that. Like you said, 20 years from now, it'll probably be even more unrecognizable. It's a great investment for sure. I appreciate you and the amazing knowledge that you're providing to your community. They are, again, so lucky to have you as a real estate professional, as a human being. I know you care about your clients, and we're not trying to bend anyone's arm about, hey, buy, but we're just trying to present the education, the data, the numbers, what we're seeing out there compared to what the media is throwing out there. And so, guys, if anybody's out there and you are on the fence, you need to speak to someone who knows this market, definitely reach out to Carlos and his team. He'll take amazing care of you and make sure that you're getting the right information and get you on your path to home ownership and building wealth through real estate.
Thank you, Aaron. Thank you. What a better way to finish this live. And here I'm just going to share really quick my phone number for those interested. My Facebook page, Carlos Cruz Realtor. My email, carlos@carloscruzrealtor.com. And then I'm going to share Aaron's page, phone number as well. Please reach out to him. He's very knowledgeable. We get to meet. We have this special group called the Elites. And it's put together by a title person, title rep that always doing this type of gatherings for us to share knowledge, basically a mastermind, brainstorming ideas, and it's very useful. And that's where I met Aaron and his team, and he's been just dropping us, with lots of knowledge, lots of information that I say, you know what, let's go live. Let's start sharing some of, your knowledge and your data points and everything. So I'm just sharing here Aaron page, his email address, and his website as well. All right.
This has been fun. Shout out to our elite
let's do it again.
Let's do it again. Yeah, let's do it again for sure.
All right. Thank you, everybody. Thanks for joining.
All right. Thanks, Carlos.
Have a Merry Christmas and Happy New Year. Thank you, everybody.
So much. Same to you, my friend. See you guys.